Hello, this is Thierry Samlal from PMML. We are live today and talking about multifamily markets, the statistics for the month of November 2022. So we're well into the fourth quarter. This year has been exceptional as far as sales value price-wise. So we're at the highest cost per door that we've ever been, basically, on the multifamily market. We have a situation where the interest rates are on the rise and where we're seeing the number of transactions greatly diminish in the province of Quebec. And if we're looking, for example, at the island of Montreal, the number of trailing transactions for the past 12 months have diminished from about 1150 transactions for the last year in November 2021, all the way down to close to 780 transactions. So what does that mean? We're seeing the number of transactions diminish. We're seeing the price per door increase. The price per door has increased greatly all the way up to, say, October, and tapered off at about an average for the island at about $180,000 per door, which is historically quite high when you're considering that the market was at about $100,000 per door not too long ago. Of course, in that $178,000 per door, $180 per door, you have units that are 4.5s, 3.5s, some studios in there, and some 5.5s, all blended into that statistic. But still, we still see that the price per door is at a historic high. Okay, we've diminished, if you're comparing to October, we lost about $2,000 worth per door of value, but that's still very historically high. So, context, interest rates are up, price per door is high. The cap rates right now are approximately between 3.5 to 3.7, depending on the type of asset that you're transacting on the market, and that's for existing buildings that are not recently built, of course. So we're in a condition where the market still has a lot of, the confidence on the market has not yet sank. It's still there, very present, but the number of players that are in the market have reduced greatly. So now what we're seeing is we're seeing only experienced buyers and sellers which have already portfolios in place, either that or either professionals that are coming in with a lot of equity in their businesses, or a lot of existing building owners that have a lot of equity in their assets that are nice and comfortable, and that could bid right now in the market. So what's happening here is we're seeing a lot of buildings which have been already renovating being sold, and that was the same situation for October. Most of the assets out there are already renovated, and the previous owners have taken out a lot of the juice out of the assets, meaning that they increased the rents on most units, but there's still some rent increase which is possible on the building, and often say 20 to 40% of the units can still be optimized. Some of them have worked on the capital expenses and have done the renovations over time, so they're able to sell assets on the market that have been already renovated. For example, the roofs, the doors, the windows, the patio doors, electrical panels, some bathrooms, some kitchens. It's rare to see that all of the units have been refurbished, but what we're seeing right now is that there's a lot of juice that came out of the assets. So that's the market right now. A lot of the optimizers are no longer there for the smaller assets, but for the bigger buildings, we're seeing a lot of activity for people that want to take over assets that need heavy optimizations. Once they buy them at correct prices for the market, it makes sense. So what we're seeing also is we're seeing large buildings being sold from owners that have detained those assets for quite a period of time, that they've been able to pump out a large amount of equity, either refinance those assets over time or purchase other assets, and are now looking to sell what they think is not worth it for them anymore. So now what happens there is not because it's not worth it for an owner anymore in properties that they usually have as far as assets, and they're selling it off in the market, that it's not a prize asset for somebody, another owner on the market, another investor that has another approach that's not necessarily a detainer, more an optimizer, or it could be somebody that's picking up an asset that is less interesting for one owner because the owner doesn't have other assets in that area. And then finally, the purchaser that's purchasing the asset is looking to add a building to another portfolio that they already have in that area. So that's what we're seeing right now. So cost per unit in Montreal stays high in the island. Cap rates are about 3.5 to 3.7, which is really interesting. Now, if you're looking at, for example, cost per unit, depending on the asset type, and you're in the 5 to 11 door version Plex in Montreal, so the smaller assets, of course, you're going to be selling at a higher price per door because there's more investors that have the capacity to buy smaller assets because the down payment is lower, and the capacity to go get financing also could be amalgamated to loans on other properties as far as equity, or just residential loans, basically. So, the average price per door there on the island of Montreal for 12 units and below, say 5 to 12 units, is about $180,000 per door. If we go up to the 12 to 24 unit range, which is really popular, and in which we have a lot of smaller units integrated, meaning some 3.5s and sometimes some studios, we're approximately 160, 165,000 per door. One of the most popular categories this year was the 25 to 49 unit category, and there were around 150,000 per door. Don't forget, in that category, we have a lot of studios, a lot of smaller units. That's why the price per door is compressed. And in the 50 door and above category, there where you have assets mostly of concrete grade, at least 3 stories and above high, going all the way up to 14 to 20 stories. That's what we're seeing on the market being sold this year, with the possibility of optimizing the rents, upgrading the common areas, but also diminishing the expenses. We're in the $180,000 to $185,000 per door price range. So interesting. Note that the 50 doors and above usually have integrated garages, some common areas, sometimes pool, sometimes extra security, internet integrated. Often the owner pays for the heating and hot water expenses in those assets also. So that could play on the price per door. But what we're seeing that the prices are increasing and maintaining over time. So although the interest rates have increased, and we're feeling that the market is getting tired in the way that there's less activity, but the activity that's still there is of high quality. And that's really compensating, not the volume, but is helping to compensate the rise in interest rates, because we have people buying assets which are interested in possessing them because of their location, or adding value, not on the short term, but on the mid to long term. That's what I'm seeing right now. So experienced owners saying, okay, I'm going to pick this up. When I have time, I'm going to slowly finish renovating my other assets, pick this one up, and then eventually do something with it. But for the moment, I'm going to pick it up and put it in my portfolio. That's what we're seeing in the market right now. The volume per category type is maintaining over the year. The 50 unit and above has been very popular this year. Why? A lot of the owners that have been detaining these assets for a long time, if it's on the Montreal market, on the Quebec market, are now selling those assets, and most of them have detained those assets for about 30 years. So they've pulled out the equity, and now they're willing to sell them on the market. So that's for Montreal. Of course, if you're looking at what sells as far as age groups, most of what was built on the island of Montreal is 1970 and less. We have seen the sales volume shrink there, definitely. The 1971 to 1990 assets, the volume is fluctuating, but keeping a good and healthy pace. 1991 to 2010 assets, the number of transaction volumes has diminished, but remember that between 1991 and 2010, condominiums were still very popular. So that's why we have some assets that were built and have done a few cycles of renewals as far as mortgages, but now those assets have been sold and there's no longer assets available in those categories. For the 2011 and above, we've seen a steady increase since January 2022, meaning that a lot of those assets were built mostly in the 2017, 2018, 2019, 2020, 2021, and now are being resold either with existing mortgages in place. Remember the mortgage rates in 2020, 2021, they were historically low. We've seen, some rates are between say 1.7 to 2.25, 2.5, which were really interesting rates. The assets that are being sold right now that have been built recently often have those interest rates in place, and the sellers are willing to sell the assets with assumptions, which makes it really interesting for a buyer to pick up those assets right now, because when they buy, first of all, although they're putting a little bit more cash down, they're paying much more equity every month on their mortgages and getting much more return cash on cash. So that's what's interesting for the most recent assets. That's for the island of Montreal. My second best choice here, let's go see Quebec City and the whole region, see what's happening there. Price per door there has been maintaining very, very high, historically high between the month of May and the month of August 2022, at an average level of $113,000 per door, which is an historic high for that area. Remember that that's an average, and that's for all category types and all age groups, right? So now we've been, since the month of August, we've been shrinking a bit and losing some price per door activity, but not that much. We've lost between $2,000 to $3,000 per door, which is, when you're melting it into the pot, not very important on the overall. So that means if you have a building of, say, of 100 doors, well, you're losing maybe $100,000 to $200,000 worth of value there on your asset. Still, maintaining very high. The cap rates in Quebec City in the region, an average of 4.47, which is interesting. And when you're looking at those cap rates, you're realizing that a lot of the assets that are being sold in Quebec City are renovated. A lot of the tenant base in those areas want renovated units. First of all, Quebec City has a few degrees less temperature-wise compared to Montreal, so you do need to optimize energy costs, and a lot of the assets still have energy cost optimizations possible, but have been already renovated, and most of them have changed doors, changed windows, etc. So that permits, again, a good rental value. And if you compare the average cap rate of about 4.47, which you'll see in our PMML index, and you're comparing to new properties sold on the market today that are newly built, you'll see that the average cap rates in that category for new build is about 4.1. So we're not too far from a new build property available. As far as transactional volume, of course, the number of transactions have diminished. We've lost about 100 transactions per year in Quebec City. So right now we're about 360 transactions in the 12 trailing months that have passed. The year before we were at about 475 transactions, but 2021, remember 2020, 2021 are exceptional years. We had extremely high transactional volume because the interest rates were very low, and a lot of the owners refinanced and pulled out a lot of equity of their buildings, and were able to get interest rates around 2%, which was really ridiculous interest rates. And being able to take that money at 2%, reinject it, and go get, say, 19% return on average on 5 years made a lot of sense. And that's why the number of transactions has diminished. So yes, the interest rates is playing in the game, but at the same time, we had a lot of money on the market that was available, a lot of cash that was available. Today, a lot of the owners are keeping the cash for themselves. They're saying, okay, what's going to happen if I have to refinance an asset on the short term? A lot of the new owners have not seen markets where the interest rates have fluctuated this much over time, so they're not used to living with the fluctuation of interest rates. They thought that it was a permanent situation, having low interest rates, which is not the case. the market is in cycle, and it's normal to have fluctuations of interest rates. For the Quebec City, always, I'm seeing a nice flat number of for the volume of transactions sold in all categories, meaning that we flatlined since, say, February. So the market is really, really stable in Quebec City. We're seeing that the volumes are staying stable dollar-wise. The number of transactions also, although they have sunk a bit, most of the sinking took place in the 5 to the 11 plex category. Same thing for Montreal. So two factors here to consider to show that the multifamily market is really still booming in the province of Quebec is if you take away the fact that, take away the transactions below 12 doors, right there you're absorbing the drop in transaction quantity since we've seen in the past year. Then add to that, if you want, add to that the fluctuation of interest rates, which is, and you'll see that the impact right now is minimal on the number of transactions. All what we're doing is we're taking off your run-of-the-mill investor that could buy on the smaller asset range, but is not in capacity to buy in the 12-unit range and above. Now, don't forget one thing. That being said, the other thing that we have to consider is that the most of what was built in the province of Quebec was built below 12 doors. We have a lot of assets, 5 plexes, 6 plexes, 8 plexes, combinations thereof and that's what we're seeing. That's most of what was built. That's about 75% of what's built in Montreal is below the 15, 16 door range. So removing that lower class asset, what is left over? What's left over is people that usually already have assets that have a certain understanding of the market and that still have the confidence of the market if they're paying the right price. Okay, that's for Quebec City. Age groups still really interesting. 2011 and over, we've seen a sink in the transactional volume because that's the simple fact is that we don't have that much asset available. There's not that much new built in Quebec City. A lot of it is being built right now or has been built, say, between 2012 and 2020, approximately, in Quebec City. Now we have new assets being built, concrete or outside of the city. For those that are searching for land, definitely if you're going to places like Lévis across the river, that's where you're going to find land at a lower price. Hyperdensification is planned on the Lévis side of Quebec City, less restrictions also to build. So interesting to see that there's variations there. Let's go to Gatineau, the national capital area, where Ottawa has a large influence on what's going on the market right now, and always has had, and now the influence is becoming stronger and stronger because we're feeling that the gap in the tenant base between the northwest side, the Ontario side of the Ottawa River, and the Quebec side is now diminishing over time, although the asset value is not the same. The average price per door is around $160,000 per door in Gatineau. A year ago it was about $120,000. Now, don't forget, and I'm repeating myself every month here, but a lot of what Gatineau is being built right now. It's being hyper-densified. It's not rare to see a zoning that permits 14-story buildings in that area. And there's a lot of new assets which are going to be popping up over the next few months. So that's to consider. But if Gatineau is a very healthy market right now, the price per door is increasing. It's still time to integrate that market to buy at the very acceptable price per door existing assets. Remember that when you're doing your acquisitions. Cap rates, we're down to about 4.2 in that area on average, which is really interesting. Now, let's talk about age, building types. The building types, the 5 to 11 unit range has sank quite a bit, and that's where we're losing our transactions in the Gatineau area. The volume has gone way up for 50 doors and above units. So, and if I'm going, we have also age groups here. That's what I wanted to show you. My age groups, there are my age groups. So 2011 and above is the age group where we have the highest asset value after the 1970 construction. So meaning that there's some assets of 50 doors and above that are being sold right now, which are of newer construction. I can guarantee you in 2024, that's where you're going to see the super hike in the values in the Gatineau area. I'm projecting it, and I can almost put my hand in the fire there. Why? Because I know those assets are being built now. I know everything's being hyperdensified. I know there's a lot of transit-oriented development sites in Gatineau that are being hyperdensified right now, and those assets are going to go up after the hike of interest rates, where it's probably going to stabilize somewhere down the line in 2023, and that's when those assets are going to be ready to build. That's where the construction costs are probably going to be leveling off, because the activity in construction right now is greatly reduced because of the high interest rates. So therefore, the recipe for high value in Gatineau is coming in 2024. Now, Sherbrooke. Let's go see Sherbrooke. We have an office down there, as we have an office in Gatineau, Quebec City. But Sherbrooke is always interesting to look at. First of all, it's a learning city, a lot of universities, as I usually say. So that has a good effect on rotation of clientele, and a good effect on the capacity to increase the rents every 2, 3, 4 years, depending on the specialty of the students that are there. A lot of them are professionals that are also going to be studying in the city of Sherbrooke in English and in French, but also going to be coming back over time and willing to buy in that area because they have a remembrance of the quality of what's going on in Sherbrooke. And Sherbrooke is doing, first of all, the quality of life is very, very high in the eastern townships. Second of all, Sherbrooke has been doing a great job to reestablish the gem that was the old downtown, and they're refurbishing that whole area and really making things make sense right now. Price per door is as high as it ever was. We're at an average of $96,000 per door in that area right now. Cap rates are down to 4.22. So that, that's looking a lot like, say, Gatineau and those secondary areas which are developing. There were some REITs last year that bought huge assets in Sherbrooke, and that really, when a REIT or a private investment fund has enough confidence in the market to buy a large asset and to be the first one to do it in an area, that's when you know where the value is picking up. And that's going to trail other people into the game, pull other investors right in there, investors that have confidence in those private investment funds and those REITs for their performance are going to want to follow. And I would do the same. I think that makes a lot of sense. Now, 50 door and above units in Sherbrooke, almost none. There's not that many assets that were built. Not that many assets being built either. Why? Because there's a lot of room for densification. So when you have a lot of room and you have a lot of land available, what happens is when you're not forced to build vertically, well, you build horizontally, and that's why we don't have a lot of 50 units and above in Sherbrooke. Now, the most popular category asset is the 12 to 24 units range in Sherbrooke right now. And the average for that, you see, if I'm looking at the average price per door for any category of asset of between 5 to 49 units right now, it's ranging between $92,000 and $96,000 per door. Don't forget that's an average. I mean, there's a lot above and there's a lot below, but we can see that market is increasing, has increased since the beginning of the year, price per door. So that means that it's important to look at that market if you're willing to buy. Let's not forget the Three Rivers market, which is Mauricie, Three Rivers. Three Rivers has been overperforming. The number of transactions has greatly sank in the last year. We've lost about 100 transactions per year in the market, where in November 2021, we were at about 250 transactions, trailing transactions per year. We've lost 100. Now, where did we lose those transactions? Well, it's simple enough to look at. We're losing it in the 5 to 11 place category. But that being said, The average price per door is at the highest that it ever was, at around $64,000 per door. Now, Three Rivers, in average, has picked up $10,000 per door of worth in the last year. That's huge. Going from 55,000 per door to 64,000 per door, that's a huge jump. How are the cap rates over there? About 4.8. So if you're a new investor, if you want a market which is still under speculated and always looking at the capacity to increase rents in the building, once you have that capacity to increase rents, if you're looking to buy in an under speculated area and you're willing to go outside of Quebec City, you're willing to go outside of Montreal, go to Three Rivers. The market's doing great. That being said, let's go see our top 5 transactions of the month. First transaction is a beautiful building, 14 stories high, Ville Saint-Laurent. I'm selling assets in Ville Saint-Laurent. There's a lot of concrete assets in Ville Saint-Laurent. Ville Saint-Laurent was already transit-oriented developed for a long time now. There's already 2 train stations there. The busing system is developed. We have 2 metro stations in that area, 2 subway stations, and this asset is very close to the, first of all, a park, very close to the Montpellier train station, which has direct access to Montreal. 14-story high asset, beautiful walk score, about 170 units with all of the amenities, very large units in square footage, and this went for close to $240,000 per door. Now, what I want you to know is if you want to buy an asset of that category today new, how much are you going to pay? I'm asking you. Of course, you can't answer because you're the other side of the camera, but it's about twice the value to buy a newer asset of this category range on the market. So you have a choice. Now, of course, if you're buying the asset which is twice the value, well, then you're going to have like high rents, low capital expenditures, and over time, and low expenses every year also. So that's a take into consideration. But if you could buy an asset which is still in good outside condition with the new regulations that we have when you're buying an asset of more than 5 stories high, you have to watch, the situation of the building on the outside. But once that's done, once you've done that verification and the building has been well maintained, well, then maybe it's worth it to go there. So it's a huge asset, picking up close to 170 units, one shot. The buyer did do a great move here. A property purchaser that bought this property already has several properties of the mid to large range size. And we have an owner which is slowly getting rid of the properties, getting out of the market. Ville Saint-Laurent also greatly influenced by redeveloping of semi-commercial sites where you're going to see a commercial center, for example, a shopping center which is being repositioned with residential assets on it, with retirement homes on it, for example. And Ville Saint-Laurent, the way it's made, there's a lot of residential property there, housing, but the number of commercial streets are reduced, and that's where you're going to find your busing system. That's where you're going to find your public transportation, the ease to move around and to get whatever you need in your daily need for daily amenities. That's where you're going to find it on main boulevards, and this one is close to main boulevard, so it makes a lot of sense for this asset to be sold. And by the way, it's a 1978 construction, so 1978 you have that. 76 to 1980 is another technology. It's a little 1970 construction, but that's where you're upscaling a bit your technology. In the last 4 years of that decade, the 1970s, there's sometimes a big gap in the quality of the assets that were built. So I think that makes a lot of sense here. My top 2 here, now we're going into Laval, a new build, 70 units for a very reasonable price, I find. 2020 construction. Interesting to see that it went for close to $250,000 per door, which for me is very cheap. So we have a builder that sold to a private investment fund here, an asset which is well located on the northwestern portion of the island. So a little bit far from everything, but still $250,000 per door. This asset today, if I would want to build it, it would be in the 325 per door price range. That means that the purchaser picked up the asset for $75,000 per door cheaper than what we would find in the market today. So, congratulations to the parties here. I'm sure that they did a transaction that was, how do we say, well documented, and everybody knew what they were doing here, because I find that the price was like way out of market. Of course, I was not implicated directly in this transaction, so I don't have all of the details of it. Anyways, third top three, Côte Saint-Luc, very popular. It has been very popular for the last few months. Many transactions taking place in that area, close to the Carry Boulevard, close to metro stations, public transportation made easy. A lot of land being densified in that area. The Hippodrome is going to be repositioned. We have Royal Mount, which is a semi-commercial office space and commercial site being installed right now. We have some residual land. Price of property is extremely high in the area. Price per land is extremely high in the area. Easy access to universities also at a short distance, and that's what gives all the value to this asset. Now, the assets in that area always sell a little higher than what we would see elsewhere. We have a 75 door here that went for close to $195,000 per door. So, very interesting asset, 5 stories. I find it's a good deal. I mean, that deal makes sense for market. That's what I want to say. Top 4, Sherbrooke West, a building that the seller started to refurbish, and now that picked back up, and it went for about $188,000 per door. Very well located, Ville-Marie West, naturally western side of the island. Properties are worth quite a bit of money when you're going west of St. Lawrence Boulevard and you're staying close to the mountain. That's where the value is, and that's where we're seeing most of the assets being sold to purchasers that are native of outside of Montreal, meaning that their companies are based outside of Montreal. Well, interesting assets, older age, 1940, close to 1940 construction, which means a lot of work to be done, major refurb inside of the building, a major refurb of your electrics, a major refurb of your plumbing, security system, roofing, windows, finishing, etc. There's a lot of work to do in these assets. So I find that still, that being said, and this asset was empty, by the way. So at $190,000 per door, that makes a lot of sense. And I'm just guessing that the owner is going to be keeping this asset on the long term. If I'm looking at the price, the renovation costs, all of that mixed, blended together compared to new build, I think that this asset is going to be kept for the long term. And when you're buying an asset of high quality and its location that has a certain history, you're able to, and has good bones, you're able to reposition that asset with good renovations. It makes sense to keep it on the long term, say 15, 20 years. Top 5. Another Côte Saint-Luc property. This one went for about $184,000 per door. A construction company sold it to an independent buyer. Once again, 1957, went for about $185,000 per door. That makes a lot of assets. We can tell that we have a lot of smaller units in this building. There's a large demand for smaller units. I encourage you to buy buildings with a good mix, meaning that if you have 3.5 and studios in your building, don't put it aside. Most of the assets of 30 doors and above in Montreal were built that way anyways. So it's worth buying, I believe. Now, as you can see, my top 5 is in Montreal this month. That's where the most interesting transactions took place. We'll see next month what's happening if there's assets being sold in Quebec. Quebec, very large assets have sold in the last year. I gave you the intel in my last reports. Now, interest rates. Where are we going? How can we counteract that? Well, interest rates are high right now, but we do have a large confidence in the market. Don't forget one thing. The residential market, meaning the homeowner market, is one thing. but the interest rates that we have right now on plexes are way lower. We have a financing department at PMML. Must have at least 600 transactions right now under financing. I didn't check this morning, but I know we have a lot in there and a lot coming out of that system. So basically, what I want to tell you here is a lot of people are looking at the MLI Select program right now. The MLI Select program, first of all, there's a need for social housing in Montreal. I think it's non-realistic to think that we could raise all of the rents in Montreal. Impossible. Even if we try to raise all of the rents in Montreal to levels that, the top market value, we're not going to be able to do it because a lot of the population cannot rent at those values. So even if you do it, you're going to have an empty unit, right? So we have to consider the fact that having units which are below, what APH, the MLI Select program is dictating right now in different markets makes sense. And anyways, probably you as an owner would have had your units for at least 5, 6, 7 years below what the MLI Select program is suggesting. So basically, MLI Select is put in place by the CHMC. It permits you with points to go, depending how your building scores, to be able to go get up to 50-year amortizations and 95% financing on your economic value. And that makes a lot of sense to counteract the high interest rates that we have right now. Now, don't forget one thing. We're in November here, so a lot of my owners told me, Terry, I want to wait till January to put my building in the market. I want to see what's going on. And a lot of people expect the interest rates to go back down. So, and we have a feeling that over time that's going to happen. I still feel a lot of confidence. This is what I want you to remember. People have a lot of confidence in the market, and people that are active right now already have capacity to take higher risks than people that were just trying to optimize and come into the market. So that we're trying to squeeze out all of the equity they could and to pay themselves back on flipping deals within 5 years, which I think is not realistic and way too risky in today's market. So I think picking up assets, maybe doing less extensive renovations, putting things back in order, cleaning up the units, putting nice common areas in place, putting the buildings back into an acceptable condition as far as rentals, fixing what needs to be fixed. I think that's what needs to be done for most of the people coming into the market. For people that are already there, gladly optimize. We're missing a lot of units in Montreal. We have immigration coming in. We also have new renters coming into the market, leaving their family nests of the younger age, coming into the market right now, and that can't necessarily pay the prices that we're seeing in Griffintown, and that are willing to go and to pay a little bit less, but go outside of the city. So that being said, I'll see you next month for my next market report. Take care. Go see our PMML index on the pmml.ca website. If you're looking for land, we also have a dedicated land website. We have a dedicated website for smaller buildings also. We do industrial, we do commercial, and of course, we do financing. So if you have questions, first of all, go see the PMML index, then call us if you want to do an evaluation that is more precise for your buildings. We are here. I'm a phone call away and available for you. So from there on, take care.